All right, hey there everyone. Good morning. This is another video lesson in my tutorial section here discussing and talking about options trading, and how you can implement them and use them to generate both income and growth of an account in this market. So this video, I'll warn you right off the bat, is going to be a long one. I've prepared for it. I've got several notes and very important things I want to discuss and talk about, because this one is about volatility, all right? Volatility, the silent killer. That's what I've titled this one. And there is so much to talk about when you discuss volatility. And when you trade options, you can take two standpoints. You can either be a directional trader or a non-directional trader. So right off the bat, you've got that choice, you've got that option. If you are a directional trader or a non-directional trader, either one, you also have to understand the element and the implications of the volatility factor. So if you are a directional price trader, you only have to worry about one thing, and that's price moving against you or in your favor. When you are trading options, either directionally or non-directionally, let's just use the directional option trader, for example. You still have that factor of price moving for you or against you, but you also have that added factor of volatility moving for you or against you. And I'll go so far as to say that every single option trader at some point in time or another, it's usually at the beginning, has experienced this influence of volatility and is completely wiped you out of a position, all right? And it's not until you further investigate and explore and understand why that is, you can be 100% correct on direction. You can be bullish a stock and you can buy a long call option. You can be 100% correct and the stock moves in your favor and you still lose money. And how can that be? Well, it is either because of volatility or time decay. And I will say probably 99.5% of the time it's because of volatility and how the volatility impacts and affects the pricing of the options. Okay, so I don't want to rush through this. I want to spend time talking about it. It's very important. I want to make sure that by the end of this lesson, if you certainly will not be a master at understanding volatility, but you will at least be exposed enough to it that you will fully be able to respect its power and know where to go for more resources. Okay, so I'm going to define, describe, talk about volatility, show the different types of volatility. I'm going to discuss my view about how I think about volatility, and then also just go through a couple of examples just showing you what I'm specifically talking about. Trade moving in your direction in your favor and you still lose money, or a trade moving nowhere and making a ton of money. And so it works both ways. So I think that this is certainly an important topic to discuss, and something that I will continue to talk about on an ongoing basis. But just know that if you're going to trade options, you fully have to respect and understand you've got an additional factor coming against you if you don't fully respect the volatility influences. So let's just jump on in and let's get started here, okay? So I'll bring Google over here. A couple of things I want to just talk about first off. So all I did is I just typed in here trading volatility. Now, if you go here to Amazon and you just type in option volatility, this is going to be the first thing that pops up here, right? Option volatility and trading. You get Amazon, that's the first link. Sheldon Natenberg, he is a highly sought after speaker. He's an author. He's an educator. This guy has really, I mean, that's pretty much the Bible, if you will, about option volatility and pricing, and how the pricing of these options are always going to favor the sellers because there's that uncertainty that's priced into these options. All right, and I will certainly talk more about that as we get deeper into this. But just understand that the edge is always going to be in favor of those who are selling options because of this option pricing model. So you really should understand that there is more to learn about how these options are priced, and volatility is the biggest implication and the biggest factor that sets the prices of these options. So this is it's not that expensive of a book, and that's only really if this kind of grabs a hold of your, your interest and you just feel like you got to learn about it. But some free resources to start here. Option Monster, these guys provide some pretty good education. Just right off the bat, I want your attention to draw towards there are different kinds of volatility. Now, the actual volatility of the stock, okay, but the historical and the implied volatility are what prices the options. And specifically, the implied volatility is the forward-looking price, whereas historical is the backwards-looking price. So this one is that kind of that lagging indicator, if you will, where it tells you what the pricing, the options price has been in the reverse, as well as the implied volatility is what the expectation or the uncertainty is going forward. So this is a good resource to read and look at. But then another one that is absolutely fantastic, and this gets deep and this gets really heady. Just if you typed in trading volatility, this PDF that comes up right here, all right, trading volatility, correlation, term structure, and skew. Colin Bennett, this is sponsored by the CBOE, so he put together this PDF. It's a free PDF. It was looks like it was copyrighted last year, 2014. It's 300 and some pages long, and it is very, very deep. I mean, we'll just scroll down here into some of this. I mean, you can see he starts talking about just all these different models and skews and volatility on volatility. I mean, it's pretty in depth. So there's some good starting points, if you will. So let's just get right on in and let's just talk about this, okay? So if we are just discussing volatility, so here's a price chart. This is the Russell 2000. Here is the Analyze tab for the same thing, the Russell 2000. These weeks are all weeks that have options that expire in them. So you've got 6 days to expiration. This is next Friday, the Friday after. These are those are the quarterlies. These are the weeklies. You've got them expiring every single Friday, and then the ones in white are the options that expire on the third Friday of the month. Okay, so those are the those are the ones where the majority of the volume and the open interest is at. So let's just look at that right now first. If I slide this over here to a little bit, what I want you to notice is this number right here. This is the volatility. And you'll notice that options that expire in a week have an implied volatility of 11.11%. Compared to options that expire in 1,000 days have an implied volatility of 21.73%. Okay, so that is a quantifiable measurement where market makers and option sellers are pricing in uncertainty and expected moves in the market. So, common sense and logic and reason tells you that the more time you have until an option expires and becomes worthless, well, the more chance there is for uncertainty to enter the market, either from, some kind of a geopolitical event, some kind of corporate event. This obviously becomes a lot more significant when you get into individual equities, right? I mean, you've got a much higher implied volatility. And then if you looked at some of the big pharmaceutical companies, well, I don't even know some of the big pharma companies. I mean, we could look up and see. Let's see. I don't know. What about, all right, so Johnson & Johnson, or let's say, Pfizer. That doesn't have a lot of volatility to it, but, maybe Eli Lilly or what's Gilead? Is that another one? Gilead Sciences? You'll see that this volatility is kind of all over the place. If you go to one, let's say Amgen, same thing, 20, 30%. So what you will notice is, let's just go back here to Priceline. This is a measurement that you can calculate how the options are going to be priced. Okay, so if I open up this chain right here, 28 days to expiration, well, now what you will notice is this is right at the money options implied volatility. The deeper in the money you go, the volatility changes. The deeper out of the farther out of the money you go, the volatility changes. As well as if you're on the call side or if you're on the put side. So what I want you to notice here is this volatility is an influence, it's an impact that if this number increases, like let's say for example, as a company is getting ready to report earnings, well, when this increases, the price of this option increases to follow suit. And that just is because there is more uncertainty. If someone is going to be taking more risk on, they are going to elevate this price to be compensated for that risk. And that can absolutely be charted and looked at. Let me slide this over here so you can see what happens. You break out studies. If you add a study, if you go to all studies, if you come down here to implied volatility, well, now what that does is that lets you look on a graphical picture, all right? And if we're still stuck on the rut here, look at what has happened here. The volatility is at 15.08, all right? Which tells you that in the past year, in the past 2 years, because that's what we're looking at on this chart, we are at the lowest edge of that range of what implied volatility has been at for the last 2 years. That means that these options are priced very inexpensively. So when something is very inexpensive, do you want to buy it or do you want to sell it? Right? I mean, so, and I'm not I'm not trying to make this silly or anything. I'm intentionally trying to illustrate the point here that when you're buying and selling options, you have to ask yourself, what's the price of the option relative to where it's been trading at? It's no different than if you want to go buy a pair of tennis shoes and you start shopping the sale papers, and if you are a consumer and you're always buying products, well, you obviously want to get the best price you can and spend the least amount of money. It is no different when you're trading options. You want to buy options when they're the cheapest they can be, and you want to sell them when that price elevates and it increases. All right, so it's very simple. The fact is, though, that the majority of options that you trade, the edge is going to be in your favor when you are selling options. Okay. And I'll explain this, a little bit more in detail. When you are selling options, you want to be selling them when they are priced very expensively, maybe when they're even overpriced a little bit, and you want to buy them back when that price falls. So, this is completely independent from price. All right, price can go up and down, and typically when price goes up, volatility will fall. You'll see right here, price is going down. What happened to the volatility? right? But if you look at this, look at how much quicker price fell. In about 8 or 9 days, it dropped a pretty substantial amount, well over 100 points in a handful of days. And then look at what happened to this volatility. Look at how sharp that incline is. Well, you want to go ahead and sell something up at this point with the intent on buying it back at this point. You can make a whole ton of profit in a much shorter time period than if you're doing it when you're down in this area right here. Okay, when you're down in this area right here and the options are bouncing around, they're up, they're down, you know, they're kind of moving all over, you'll see that what the price is doing. The price is still elevating and then it's trading sideways, but so are these option implied volatility. That's up, that's down, it's a little bit up, it's a little bit down. You know, there's this constant retracement just like there is in price. So if you are going to try and sell options at this point, that is a very difficult game. You have just made it exponentially harder for yourself because any kind of an increase in this volatility makes these options that much more expensive and you have to buy them back. So this is implied volatility. This is all I'm talking about right now. Okay, so I want to show you statistical volatility. Same thing, we'll add all studies. Come over here to, actually, you know what, I think Thinkorswim calls it historical, yeah. Historical and statistical are terms that are interchangeable. All right, so you'll see that it looks very similar, but it is a little bit different. And if you want to see why it's different, well, let's go ahead and edit the studies. Now, if we put them together in the same window, now you'll see what ends up happening is they're overlaid on top of each other. So now you might have a big hard spike in this area that I was showing earlier. Well, this is implied volatility, the overpricing of these options, and the statistical volatility, which is what looks in reverse in a rear view mirror, hasn't quite caught up with it. So this little burst above the statistical volatility is implied volatility, and that is uncertainty, because look at these big candles that are moving down. There is no guarantee that it couldn't just continue dropping. So the volatility is in these option prices to compensate, I guess, for that risk of that uncertainty, okay? Now, when it obviously dropped, you'll see as soon as it started taking off and going to the upside, well, all of that implied volatility came out, but the statistical volatility, the historical volatility is still up there because it is looking in reverse. So now it's going to beta weight all these big candles that are still in, whether that's 10 or 20 or 30 days in reverse. I think this is, 20 days in reverse. So, you know, I could change that, edit studies. Let's get rid of this just for the moment. I could change that to, 10 days. So it would only look in reverse for 10 days. And you'll see now it changes that. Or I could make it 30 days or 40 days or however much time you want to look at. The point is, historical volatility is it's already happened, it's after the fact, the options are closed, the price is known. Implied volatility, price is not known, you don't know where the market is going, and that uncertainty is what makes these options either very expensive up here when volatility is high, or very inexpensive down here when volatility is low. So that is absolutely mandatory to understand the differences between the two. If somebody just says, well, what's volatility? Well, you need to not assume that they are just talking about implied volatility. Somebody may be talking about historical volatility, and that is entirely different, completely different. So this volatility right here has firsthand changed what the prices of these options are going to be selling for. Again, like I said, pretend that these are not options. Pretend these are a pair of shoes, or pretend it's a home or a piece of real estate or whatever. I mean, real estate, perfect example. So, right in here you have a measurement, implied volatility of what the market thinks these options are fair value priced at. All right. Now, if all of a sudden a dirty bomb gets put somewhere in New York or LA or Tokyo or somewhere in the world, and all of a sudden it introduces a lot of chaos and instability and uncertainty, all right, I guarantee you that's going to influence and change this volatility, because that is now uncertainty, and it's going to increase and elevate these prices. With all other factors being the same, if you change this, you are absolutely going to change the price of your option. So when that happens, when your option is priced at one level, you have to understand that these prices can change in a second without the price ever moving a penny. So volatility is always changing. Price is always changing. The two are usually dependent on one another, but not always. Okay, so I really wanted to spend some extra minutes talking about this, because let's just use this example. Let's say now that I have bought a call option. I have a directional opinion. I have let's lock this in. I have a $2,000 bet that I think the market is absolutely going to go up. All right. Well, what you will notice from talking about the Greeks, I have this volatility influence where every single point up or down in volatility is going to make or lose me money. So I can be absolutely correct on price, but let's just say, for example, that if I am vega positive, okay, I want volatility to increase. So if volatility increases, I make $138 per point of increase in volatility. If the market is moving up, what do you think volatility is going to do based upon this? Market moves up, volatility moves down. So market moves up. If this is all of a sudden now, let's say it's an out of the money call. Let's not go that far out. Let's go right here. If that's an out of the money call option, market can move up, volatility will go down. I will lose money even though the market moved in the direction I wanted it to go. All right? That is insanely important to understand and to process, because you can pick a direction correctly, and if you aren't understanding how this volatility can impact your trade, you're left scratching your head because you have a 100% losing trade, but yet you pick direction correctly, and you're like, well, screw this. This is stupid. Why do I want to trade options? Because, I picked the direction right. I made a directional trade, and I still lost all my money. It happens all the time if you don't understand and respect this volatility. Okay, so obviously the reverse is true. If we came out here and if we sold some vertical call spreads, well, look at now I'm negative volatility. Yeah, that means that for every point down in volatility, I make $14. Or if we, do 10 contracts, I'd make $142. However, if the market moves up, if the market moves down and volatility goes up, you're going to lose that money. And let me just show you right here, I can simulate this vol adjustment. So if I bought this, or if I sold this for $40 10 times, I'm going to make essentially $400. Well, what if now all of a sudden the volatility starts going up by 1 point? Well, now look at what happens. Right off the bat, The market could stay put and not move anywhere. Price can not move anywhere, and volatility can move up by a point or two. All right, if volatility moved up and the market went nowhere, and you were in a trade that all of a sudden is now down several $100s, and the market didn't even go anywhere, you will be left scratching your head saying, what in the world is going on? It is volatility. And remember what I said, this volatility changes the pricing of the options. So if I have bought an option and it's very, very, very expensive, and then all of a sudden the volatility decreases and the option is very cheap, well, I'm going to sell it for a whole lot less money than what I bought it for, and I'm going to incur a loss. So, okay, sorry. So I think that's absolutely important. It's a concept that will take some time to get worked through, but just understand that when we're talking about volatility, I'm talking about implied volatility. I am talking about the relationship in volatility in the past to where it's at now. And if you will notice right here, no way in the world do I want to be selling options right now. Okay, hold on just a second. No way in the world will I establish a big option trade position right now with volatility as low as it is. I would be more than okay with selling these options just on a smaller scale, smaller position size, and then scaling into something as it elevates back up into this range. If you initiate a trade position up in this area, okay, you're gonna gain a lot of benefit when this volatility comes down, regardless if the market moves up hard or not. Okay, so there's two different approaches, and I'll work through a couple examples to show you what I mean by that. I guess I have this fear, I have this concern that if I don't spend quite a bit amount of time talking about volatility and why it's so important to understand and why you absolutely have to, respect it. When I start showing things like this, and I'm showing you some of these PDFs that, I want you to understand that, when you look at stuff like this, I mean, this is heady, deep, really hard to understand stuff. And there are people that spend their whole entire lives and careers talking about just this volatility. You can read about this and you can understand how the volatility is constructed, how it's measured, how it's calculated, all of the theories in the world, all of the definitions, all of the what-if scenarios, all of the calculus algorithms, I mean, on and on and on and on and on and on and on. But what is the bottom line? The bottom line is, if you are trading options, yes, you are going to be exposed to volatility, but the bottom line is you are exposed to pricing of these options. And the pricing of these options, the only way you can control them, all right, you can't control the who prices them or how much they're priced for. You can absolutely control, once you have a position on, how you manage that absolute risk that you have on. And that becomes way more important, in my opinion, than trying to decipher and regurgitate or articulate exactly how the Black-Scholes option pricing model takes into consideration the volatility of the backward look, blah, 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 right? I mean, I am not smart enough to figure all that out. I'm not going to pretend to be smart enough to figure all that out. I don't want to figure all that out. But you have to be aware of it, how it can impact your position, because when you get something like this on, let's say that you want to you get a butterfly trade on that looks something along this line right here, and let's say that we've done this right here, and maybe we will add something like this in here. I'll have to do this a whole bunch of times. You get a trade on that looks something like this, all right? You have to understand how this change in volatility will affect you, and you have to understand where you sit along this position of making or losing money based upon price moving and based upon volatility changing. All right? I hope that makes sense. I really, really do, because I think that I spend a lot of time respecting and understanding volatility. I spend more time managing trades and managing my positions, because let's face it, that's the only thing I can control. I can control when I open or close a trade. I can control how much money I'm willing to risk on a certain trade. I can control when I make that adjustment. I can control when I take my profits. All the other influences, specifically volatility or price action, I have no control over. Okay, so I think that there's a lot of resources to help you if that interests you to get deep into this. But I think it's more important that you just understand it's risk management, it's position management more than anything else. So I think that that's probably all that I really want to talk about now. I want to bring this over because I want to show you a couple of examples, and this will allow me to do it in a much more rapid fashion. It's still going to take, a little bit of time to walk through a couple of trades, but I want to walk through a couple of trades. I want to walk through a couple of trades to show you how volatility impacts these positions when you're on the right side of it and when you're also on the wrong side of it. And please, I guess I should have said this at the very beginning. These are just my thoughts on how I look at volatility. I am not trying to imply that this is the only way. I mean, there are some people that trade only volatility very successfully and are very good at it, but this is just, how I view trading options in this market with my thoughts about how important and how influential volatility is. Okay, so again, just understand there are many different schools of thought on how important or how unimportant volatility is, and this is just how I look at it. So let me do this. Let's go ahead and let's look at a point in time on the chart. I think this would be a good spot. Let's say October of 2014, when volatility was the highest that it's been in the last couple of years. What's this date right here? So that is October 16th, all right, which is this date right here, October 16th, where we've already hit the bottom and now we're on the rise back up. So let's just say that, for the conversation, for the illustration here, these options are very expensive. Implied volatility is high. These options are going to cost you a lot of money. And what I want to show you is if I were to go into the market at this point in time, and if I were to buy options that are ridiculously overpriced, okay, and try and sell them back at a later point in time, I want to show you how much more difficult that is than if I were to go in here at the market and sell options at a point in time when they're overpriced and try and buy them back when the price comes down. The edge is always in the favor of the option seller. So just remember that. The option buyer is always working against both time and volatility. And the perfect example is that right there. You are always working against time. Your theta is always going to be negative when you buy options. Your volatility is always going to be positive when you buy options. If volatility drops and time passes each day, you have two factors working against you every time you buy an option. Additionally, the market makers that price these options, all right, the market that prices these options is going to build in that uncertainty of that implied volatility. So the only way to ever get the true actual price is by looking at historical volatility. That is what gives you the rear-looking price. All studies, historical volatility. Sorry, I thought I left it on there. That gives you the rear-looking price. That is the true price of the option, okay? You can't trade it because the time has already passed. Implied volatility is what we trade. Implied volatility is what we sell or what we buy. And when you buy options, you are working against, the calendar is working against you. Volatility is working against you unless you get a massive explosion in this volatility, like say, for example, a news event or an earnings announcement or a world political event of some sort, a central bank surprise announcement. What happened? The Swiss National Bank made that surprise announcement in January of this year, January, February. I mean, it just completely shocked and rocked the currency markets, right? So you get surprise movements, and that's going to absolutely explode volatility. So when you are buying options, you will benefit in that kind of a situation. But how often do those kind of situations happen? So just understand that the edge, the favor, the advantage is always going to be in the direction of the option seller. The option seller. You sell premium. All right, so let me just walk through what I said, October 16th. So let's just go back here in time. And let's go to Backtrader. We will go to October 16th, 2014. And we will just go to the end of the day and hit start. I warned you guys. I told you this would be a long one. It's certainly not to be underestimated. But, you know, I will say it's also something that you don't need to make yourself insane and crazy and schizophrenic with trying to, you know, completely understand and take advantage of, you know, everything about it. Now, this right here, you see this number up here, this VOLTI, SV, that is statistical volatility, 22.7%. If I look at that on a price chart and I overlay volatility on top of that, I will zoom in. You can see, look at the candles, you can see the market moving down has caused this right here, the IV to elevate. SV is down here. Let's go to this date. Look at SV, 22.7. IV is 23. All right. It's in the 59th percentile over the prior year. And you'll see that as you mark along here, very seldom, very seldom is statistical volatility ever above the implied volatility. So these are the times when, you know, you may find a slight, very slight advantage into buying the options because the implied volatility is a little bit less than the statistical volatility. But it's much easier and it's much simpler to sell options and sell premium when the implied volatility is overpriced, and it's because of this uncertainty. So you'll see right here on October 16th, we had the statistical volatility at 22.7, and we can go back here to this day, October 13th, which would be an actual optimum perfect time to sell premium because our statistical volatility is 19.5. Our implied volatility is 26.5. So on October 13th, if you look at that right here, okay, that's almost at the low of that move. If you look at that right here, right, I mean, this is the RVX, which is the volatility index. It still had a little bit of movement to go until it got up here to the peak on the 16th. So either one of those 2 days is going to work fine for this example, but the RVX is the actual index that tracks the volatility of the Russell specifically. So if I want to go in here and let's just say I want to buy options at this price right now because I think that the market is absolutely going up, well, let's just say I come right here at the money and I buy an option. All right, I have theta working against me. I have delta, which tells me I will make $50 for every 1 point move up. And I have vega that's plus 136. If I convert that trade, I've got 36 days until expiration, and this is what my risk profile looks like. Okay? Now, if I look at this chart, obviously I don't know what's happened in real time, but you know, I can see that right off the bat, it's going to move quite a bit right after I put this trade on. But what I want you to pay attention to is how much this option changes its value when I paid $29.15 for it with volatility being as high as it was. If I just move 1 day in time, all right, we had a sideways move, but look at what happened. I paid $29 for it, and now it's only worth $25, and the market only moved 3 points. It did not move hardly anything, and already now I'm down, you know, well over 10% of my capital, and look at where I'm at. I mean, it didn't really do anything. I move another day, and now my option that I paid $29.15 for is now, what's it worth? $29.60, because I had a really, really big move up, right? So each day, this theta is going to get larger and larger and larger. And what you'll notice here, another massive move up. Now this option is worth $39.35. So in this example, you'll see that we made a good directional opinion. We made a good trade. We are up a lot of money purely on price. All right, but watch what happens in just a couple more days as this theta begins to take over what that option is priced at. Okay, well, we're still moving up. We're still moving up. And option view is very, very slow sometimes. All right. Now we're still up, and we're going to hold right around this area, and then as each day passes in time, this will drop until this dotted line matches this solid line at expiration. This value right here is a model for what the changes in volatility will do for you. Now, you'll see that volatility, our statistical volatility, is still at 22. And we put this trade on, look at this today here. We put this trade on back over here, and it has still stayed kind of horizontal. If we went forward a couple more days in time, you will notice that the volatility influence becomes less and less, because the market has moved significantly up, right? And now our expiration line is decisively above our break even, our profit and loss graph. When you change your volatility levels either up or down, plus or minus 5%, that's what changes your theoretical profit or loss in your trade. So you'll see that this particular trade, the only reason that this became a profitable trade is because what did the market do? From October 16th to October 29th, we moved right here to right here. We had a very significant move that was able to overtake this drop down in the volatility. If we came back to a point in time where a significant drop in volatility did not correlate with a big move up in the market, you would see a different outcome. Okay? We still made money even though volatility was working against us, purely based upon price. Watch what happens. Let me just get rid of this trade. 1016. Actually, you know what? Let me just get rid of all these because I was working on a little something there. Get rid of all those. We'll go back to the 16th. And now instead of, and I just want to show you again, two completely different examples. That example made money, but just understand that that is only because this moved up. The price had a very strong move up, okay, and it was able to overcome this volatility. If we will do something very similar, and let's just say we want to construct a negative Vega trade, all right? A negative Vega trade takes advantage of the volatility coming out, and let's say that that is something like this, to where maybe I want to sell 6 of these, I'll buy 3 of these, I'll buy 3 of these, and it maybe looks something along this factor. Looks maybe something like this, to where it's pretty unbalanced. We have about $4,500 worth of risk on the downside. We've got only about $1,500 worth of risk to the upside, and this dotted line is pretty symmetrical. Okay. This change in volatility, I want you to notice, if the volatility continued to increase, look at how much money I would theoretically be losing. Conversely, if volatility decreases like it does, I want you to notice how much money we would theoretically be making. Okay, so if I go ahead and let's just convert those trades, I step forward to a few days in time, we'll see what this looks like. You'll see that we are certainly up money. However, we are nowhere near what we were up in the different example, because again, we were not making a directional bet. We were making a non-directional, pure volatility based trade. We'll go to the 29th just to compare apples to apples. And what you notice here is this trade has actually now lost money. We are way outside of our potential profit area, and now we are getting ready to begin losing a lot more money if the market keeps going up. So the volatility impact on this setup was a lot different than the prior setup, when we were making a directional opinion and we were making a directional trade that went straight up, and we were able to overcome this drop in volatility. I think that it's boy, I don't want to just continue to go on and on with this. I think that that's probably enough that I want to just show it, share with you and illustrate now, because this would not be the way you would trade this kind of a move. But I want you to see that when you pick different areas, and you're going to make a directional trade or a volatility-based trade, you have to understand that both of those factors are moving against you. And the odds are going to favor someone that, say, you come out here to about a 10 or 12 or 15 delta. Say you've sold these and you do the same up here. you've sold these, you've put yourself in this kind of a trade setup or a trade position where you benefit from a decrease in volatility, and you can withstand a pretty substantial, a pretty substantial move to the upside where, let's go here to the 29th, you have a much larger Vega component, and yet you still don't realize as much profit as you would have with a directional trade. So volatility, I think it's certainly something that will take a lot more discussion, a lot more conversation, but I really need you to understand that this mid IV price, this implied volatility price, is directly related to this right here. Implied volatility. And so right now, the time to make directional trades is, do you think this market's going up? Do you think this market's going down? Understand these options are very, very inexpensive right now. And I tell you, a absolute, I don't want to say it's a, a guaranteed win rate trade, but there are a lot of people that are right now buying way far out of the money options, okay? And if we just look at, say, 60 or 90 or even 100 days to expiration, and you can buy something that's way out here for, you know, maybe $100 that has this kind of a risk profile to it. And if you think that we are long overdue for a very, very sharp correction, not only will you benefit from a strong move in direction, but look at the amount of increase you get from an explosion in volatility. Okay, so I think that's all for now. This is not the end of the conversation. Please understand there's a lot more to talk about with this, and understanding the differences between both implied volatility and statistical or historical volatility is important. But the most important thing in all of this that I want you to get is how you manage your positions, how you manage your trades, what your opinion is at the beginning. Are you a directional trader? Are you a non-directional trader? And how you approach both of those mindsets is completely different in how you manage your trades. And how you manage your trades is more than important than how you manage the volatility. Okay, so I hope that helps. I definitely hope that is either, I hope it's answered a few questions and it's provided a little bit more clarity, and I hope it hasn't confused or added more murkiness to the waters, because this is absolutely something that can overwhelm even the most dedicated and determined traders, but it doesn't have to, okay? Because please trust me, if I can sort this out, and if I can navigate through this, and if I can figure out how to be a consistently profitable trader, I know for a fact that you can as well, okay? So don't let the complexity of it overwhelm you. Just keep it simple, keep it easy, and keep it on demo until you're ready to make that transition into live trading, all right? So thank you so much for bearing with me for this. This will probably be one of the lengthiest sessions that I'll put together in all these tutorial lessons. Maybe the final one, you know, kind of putting it all together where I show a couple of lessons or a couple of strategies and methods. That might be about the same length, but certainly I don't intend for them always to be this long. So thank you so much for listening, for hanging in there with me. And as always, I'm open for any questions or thoughts or continued conversations about this stuff. I love it, and I can't get enough of it. All right, guys. Have a super great day. Bye.